Record high inflation continues to inflict pain on people and businesses and products across the country. From Main Street to Wall Street, the hurt is felt. Stocks on Wall Street have lost more than 20% of their value so far this year. It's been one of the worst years in recent memory. If 2022 ended yesterday, this year would rank as the 7th worst performing year for the stock market since 1928. Also, new data from the Commerce Department shows the U.S. economy actually shrank during the first half of the year, the economy contracting by 2.2%, leaving some to wonder if inflation is pushing us toward a recession. Joining us now to discuss the state of the economy is Mary Daly, the president and CEO of the Federal Reserve Bank of San Francisco. Mary, thank you so much for coming on the show again. We always enjoy having you on to talk about this. Let's get right to it. Inflation is still very high right now. The Fed has come under criticism for either not responding enough, responding too aggressively. It's been hit on both sides. So what do you say to the critics about how you all are handling inflation?
Well, the first thing is our number one priority is to get inflation down. American consumers, businesses are suffering from the high inflation, which is eroding their lives and livelihoods. That is why we've taken a very rapid pace of increases to bridle the economy, get demand back in line with supply, and give relief on that inflation front. And we're starting to see the benefits of those rate increases. I'm here in Boise, Idaho. I'm seeing the housing market cool, and people are feeling a little bit of relief, which is frankly very welcomed.
That may be the case, but inflation is still up above that 8% mark, not what we all want to see. I know you guys like to have it in that 2 to 3% range. So what more do you need to see to have that happen?
Well, we need to see a lot more relief on inflation. You're absolutely right. When I say there's a little relief, that's welcomed. That is not full victory by any means. And we really want inflation to be back around 2%, as you said, and that's going to take some time. But the rate increases that we've taken and the ones we project taking additionally are the ingredient that will help bring inflation down. And we're also seeing some relief on supply chain starting to form. Of course, those things together, relief on demand's a little bit slower, and supply is a little bit better. That actually delivers the lower inflation that everybody wants.
There are some predictions, though, that say the rates could go as high as 4.25%. You guys have more meetings this year. How much higher are you going to go? How many more times are interest rates going to be hiked?
Well, we have 2 more meetings before the end of the year, and each of those meetings has considerable data that will come in before we actually sit down and discuss and debate. So, I do believe we will take additional rate hikes. I just think that's the right thing to do to bring the economy back in balance, to give the relief on inflation we just talked about. But exactly how high we will go by the end of the year, that depends on the data. And I think that's the thing. When you get criticisms from both sides, we're not moving fast enough, we're moving too fast. It really is about being data dependent. That's the thing I want all your listeners to know. We don't have a preset course. We really look at the data that's incoming and we say, what is the best thing to do for the economy? Because ultimately, if the economy is in better, more sustainable shape and inflation is lower, everyone benefits, every consumer, every business.
And with the Fed's actions, there have been more and more concern about pushing us into a recession. That R word. Do you guys fear that at all? Is it even a part of your calculation whenever you make the decision to raise rates?
Sure, that's a terrific question. And I would say that, obviously there's a sense that the economy is slowing. And what I'm seeing, though, is we're still adding over 300,000 jobs per month in the U.S. economy. We only need 100,000 to just keep the unemployment rate steady. That's 200,000 more jobs than we need to keep unemployment where it is. So that's not an economy that's teetering on recession. That's an economy that needs to slow to a sustainable pace. So before we get ahead of ourselves and worry about recession, I think we should just get the economy slowing in the way that we need to give that all important relief on inflation. And here in Boise, Idaho, which is, a booming economy, I'm seeing that relief forming. It's moving from frenetic to something that feels more sustainable, and that feels more practical for people, more like they can live their lives and they can stop thinking about inflation and they don't have to worry about catching up because they can just go back to living the lives they want.
I know some of this talk about the Fed, the interest rate hikes can be filled with kind of business lingo and jargon. Could you just explain in the most basic terms for people who may not be familiar with the financial terms, how a rise in interest rates affects things like credit cards, home loans, et cetera, things like that?
Absolutely. So the Federal Reserve raises the interest rate, and what immediately happens is other interest rates, the ones that matter for people, the mortgage interest rate, the car loan rate, the credit card rate, those go up. And when people face higher costs of borrowing, they borrow less and they spend less. And then that filters through the economy and it starts to slow demand. The place that I think is just easy to see this is we raise interest rates, the Fed, mortgage interest rates went up 6.7% printing right now, and that slows housing demand. And when that slows housing demand, house price appreciation slows. And then another really important thing that so many Americans face, rental price inflation starts to slow. And that is just hitting the pocketbooks of Americans right now. It's high and rising. That slowing will give much welcomed relief. That combined with gas and food, that's a big portion of what Americans spend their money on, and that's what we're looking for. That's
So,
how the interest rate policy we have works.
so many dominoes that fall from that decision. All right, President Daly, sit tight. We have to take a quick break, but we'll have more right after this. Welcome back. Let's get right back to our interview with Mary Daly, President and CEO of the Federal Reserve Bank of San Francisco. Mary, thank you so much for being so generous with your time this morning. We really do appreciate it. Researchers at your bank recently did a study that the work from home shift during the pandemic that we have recently seen may account for more than half of overall home price increases and could be a main driver of inflation. So explain that to us. How is working from home correlated with higher inflation?
Sure. So what happened is that so many of us started working from home. And when we work from home, we have two things that happen. We want a bigger place to live. You don't want to live in a small place because you got a lot of family there and you're all trying to work from home, go to school from home. And then you also can live farther away from the location of the headquarters where you're working. So a lot of people moved into these communities. You know, here in Boise, Idaho, really this happened. A lot of people from coastal communities moved to Boise and they brought a lot of money with them, and housing prices rose quite a bit here, priced out most of the first-time home buyers who had grown up in Boise or Idaho. And that dynamic is happening not just here, but across the country. And that has been a driver of home price inflation, rental price inflation, and overall inflation.
Such just one ingredient to a much overall picture here. The economy, of course, can be very complicated to unpack. There's the jobs, there's the unemployment rate, inflation. Never easy to understand, but right now it kind of feels like we're in a recession. On top of that, the U.S. GDP fell for the second straight quarter. So, in your opinion, how healthy is the economy right now, and are we slipping into a recession? Are we already in one?
Well, I look at a whole host of data. And so if you look at GDP, which frankly most people don't think about every day, what they think about, it looks like, wow, negative growth. But if you ask most individuals when I travel across, I have 9 states in the United States, the whole Western United States. I go to any of those states, and here's what I see: busy airports, filled up restaurants, people going to shows and games, and just being out. And I see an economy that feels good, feels solid. But the number one concern everybody has, we all have it, is inflation. Inflation is just too high. And so there's a sense of, wow, things feel good in one way, but I'm falling behind every day, every month, because my wages aren't keeping up with the prices, and my business can't sell things at the input costs I have, can't pass that fully on to consumers. These are the things I feel. And so what really has to happen, this is why the Fed's resolute in bringing inflation down, we have to get inflation down. If we can get that to happen, with these kinds of conditions, we'll go back to that sustainable sense of normal that we all crave.
It seems like you guys are prioritizing bringing inflation down more so than your fears of slipping into a recession. Is that a fair assessment, that your main priority right now is on that high inflation?
It is our main priority. That's the thing that is the most out of balance. I mean, we mentioned it at the top of our discussion. Inflation's coming in over 8%. that is unsustainable. And the important thing that I think many people, don't think about is that high inflation actually makes us vulnerable to the economy tipping over into recession or falling into a bad situation. It just makes the economy more fragile. So getting inflation down is actually strengthen the economy, making a future for the economy and our future pace of growth much more both sustainable and healthy.
In the meantime, inflation still, as I said, is above 8%. So what is your message to impatient Americans out there who are struggling to pay their rent, other bills, on how they can save money right now? What do you say to them?
Well, we're seeing Americans do what Americans do. They're substituting, they're buying things in bigger quantities and sharing them with their neighbors. They're making modifications in their spending behavior so that they can make ends meet. But the other thing I want Americans to know is that the Federal Reserve is resolute, we're united, we're focused on bringing those numbers down. And so while they won't get to 2% by the end of the year, they will start to come down. And we're seeing some relief, but we're going to keep working until that relief occurs for everybody.
So real quick, just 10 seconds. You said not 2% by the end of the year. When's that going to happen?
Well, I'm hoping we can get there because of the supply chains and our policies. We can get there in the end of 23 and closer to 2024. But there's a big difference between 8 and 2, and chipping away at that is going to feel like relief for people.
Mary Daly, President and CEO of the Federal Reserve Bank of San Francisco. We always love having you on the show, Mary. Thank you so much for your time.
Thank you.